My name is Anna. Today I want to present you a presentation on the topic the forms of taxable and tax-deferred acquisition, the tax consequences to the parties to a corporate acquisition. Also, I wanna say sorry if you're gonna hear some sounds. My neighbors are doing construction and I cannot do anything about that. So, learning objectives taxable and tax deferred corporate acquisition, the acquisition tax model, tax consequences to a corporate acquisition. Let's talk about taxable and tax deferred corporation acquisitions. Business acquisition is the process of acquiring a company to build on strengths or weaknesses of the acquiring company. A merge is similar to an acquisition but refers more strictly to combining all of the interests of both companies into a stronger single company. The end result is to grow the business in a quicker and more profitable manner than normal organic growth would allow. Also, you should know if you are a reporting corporation, you should file a Form 8806 to report an acquisition of control or a substantial change in the capital structure of a domestic corporation. Tax model for corporate acquisitions. The acquiring corporation can acquire the target corporation through either a stock or asset acquisition. The acquisition can be structured as either taxable or tax deferred. Taxable asset acquisitions allow the acquiring corporation to step up the tax basis of the assets acquired to fair value. In stock acquisitions and tax deferred assets acquisitions, the tax basis of the target corporation's assets remaining at the assets carry-over basis. The acquisition tax model. In a taxable stock acquisition, the buyer acquired stocks from the target company shareholders, who are taxed on the difference between the purchase price and their outside basis in the target stock. In a taxable assets acquisition, the selling corporation is taxed on the excess of the purchase price or its inside basis in the assets sold, and the selling corporation's shareholders are taxed on the distributions of the sale proceeds. Types of corporate acquisitions. When negotiation and acquisition, management of the acquiring corporation must decide whether to acquire assets or stock and what to use as consideration. As you can see, we have two types of corporate acquisitions, taxable and tax deferred. Example of taxable stock acquisition. Alpha acquires the stock of three standing C corporation Tango for $50 in cash. Tango's inside basis in its assets is $25, and Tango shareholders have an aggregate outside basis of $15. What is Tango's taxable gain? Tango has no taxable gain because this is a stock acquisition. What is the aggregate taxable gain to Tango shareholders? The taxable gain is the value of consideration received less the shareholders' aggregate basis in the stock sold, or $35. What is Alpha's resultant basis in Tango's assets? Carry-over basis of $25. What is Alpha's resultant basis in Tango's stock? Stepped up basis of $50. Example of taxable assets acquisition. Suppose instead that Alpha acquires Tango's assets for $50. Tango's is then liquidated and distributes the after-tax cash proceeds from the sale to its shareholders. Tango's tax rate is 35%. So, what is Tango's taxable gain? the taxable gain equals the consideration received less Tonga's inside basis units assets, or $25. What is the aggregate taxable gain to Tonga's shareholders? The taxable gain equals the after-tax proceeds distributed less the shareholders' aggregate basis in the stock sold, or $17.5. What is alpha resulting basis in Tonga's assets? Stepped up basis of $50. What is alpha's resulting basis in Tonga's stock? Why? Stepped up basis of $50 because taxes were paid at the shareholders level upon liquidation. Tax consequences to a corporate acquisition. Mergers and acquisitions (M&A) are transactions in which the ownership of companies, other business organizations, or their operating units are transferred or consolidated with other entities. As an aspect of strategic management, M&A can allow an enterprise to grow and or downsize and change the nature of their business or competitive composition. Taxable acquisition. In Wikipedia, you can see the tables a list of the largest mergers and acquisitions in each decade. Transactions values are given in the USA dollar, value for the year of the merger adjusted for inflation. As of March 2020, the largest ever acquisition was 1,999 takeover of management at $183 billion. Huge amount. Let's talk about taxable acquisitions one more time. So, cash purchases of stock are common for public firms due to non-tax advantages. And stock acquisitions for cash results in the acquired company retaining its tax and legal identity. The acquiring company can liquidate acquired company into itself or merge it into an existing subsidiary to remove the subsidiary. If you want to see example about that, you can see it on my slide over here. Tax-deferred acquisition. Taxpayers can reorganize a corporation in a tax-deferred manner under 251 paragraph. For tax purposes, reorganizations include acquisitions and dispositions of corporate assets, corporations restructuring of its capital structure. Over there, you can see example about tax-deferred acquisitions. I think also we should talk about tax-free acquisitions. Let's talk about that and see what does it mean. One major determinant of the tax implication of M&A, and you remember what does it mean M&A, right? So, of M&A transaction is the acquisition structure, assets with stock purchases. The other major determinant is the form of consideration, cash and with stock, paid by the acquirer to the seller. If the consideration is mostly cash or debt, the deal is likely to be taxable. If at least 40% of the consideration is acquiring stock, the deal is more likely to be non-taxable. 50% is the technical threshold, but transactions with as little as 40% stock consideration have qualified for tax-free treatment. There are four bases tax structures that you can see below, and we can use it in our life. Conclusion. Today we talk about what are taxable and tax-deferred corporate acquisitions. We defined what is the acquisition tax model. In this presentation we talk about tax consequences to a corporate acquisitions. There are sources that are used in my presentation, and thank you for your